understand the economy, you have to understand human nature.
This podcast is powered by Acast.
How are you doing there? You might hear John. First of all, I hope you're well. Hope life is flying along. You're enjoying Ireland's midsummer blizzardy type weather and all is good. You might hear John just sniggering there. It's
because you're a Luddite, Mac. You're a Luddite.
Because he worries about my inability to use the technology at any level of any competence. John, you might be laughing. We're going to talk about investing this week. We're going to talk about global markets, but I just
Let's
see...
just wipe the smile off my face.
Exactly. But I just see, and it'd be very, very difficult for you to really get your head around this, which is cannabis stocks, which I know you're interested in, have failed to produce an investment return, right? So there was an enormous, and you, I think you were about to put your pension into...
That was my pension pot.
Exactly, into cannabis. John was going to do this. There was a extraordinary boom in marijuana stocks in the United States and in Canada in particular.
Yeah. About
4 or 5 years ago, Canada legalizes weed. It's 2018. There's some companies come up, etc. Massive hype. And of course, what has happened is...
It didn't hit the highs that they were expecting.
Exactly. It didn't get as stoned as they were expecting it. What basically happened is two things. One is a market glut, which you'll know about. Okay.
Yeah.
Basically, too much weed. They overestimated demand.
Yeah.
So too much weed was produced, number one. And of course, there still is illicit drug dealing. So that undermined the whole thing. So the combination of both.
Yeah.
And those stocks have gone down, John, 80%.
Oh, I'm so
80%.
glad.
So all the stoners out there who thought that...
Who smoked the profits.
Anyway, we're going to talk about...
Do you know, if that was back in the 70s, you know, when there was milk lakes and butter
Wine
mountains.
lakes, yes. Butter mountains.
A weed forest.
Exactly. So we're going to talk about why smoking very, very large Camberwell carrots is not the best way about strategy. But we're going to talk about global financial markets. We haven't talked about it for quite some time, John. What's going on in financial markets? What's going on in interest rates? What's going on in exchange rates? What's going in bonds and equities? And of course, this is all against the background, John, of last week, the ECB, for the first time in 5 years, cut interest rates. And the reason this is important is it's not the actual 0.25% decrease in interest rates that's important. It's the sense that a cycle has peaked and is maybe moving downward. So you get the upward cycle and the downward cycle. We're going to talk now to a real expert.
Before we go there, can I just ask you, because if you can give me the answer succinctly.
Wow, very difficult. Thank you. That's what, you know, a school teacher would say to you. Yes. David McWilliams, we'd like the answer, but we'd like it precisely and in succinct fashion.
But I've always struggled with this 2% inflation, and who set who thought it was a good idea? It was question. 2%. Why 2%?
All right. There is absolutely no economic reason at all for the 2%. Okay. It could have been 1%, it could have been 2%, it could be 3 or 4. So what John is talking about is all around the world in the last 20 years, maybe 25 years, central banks have become independent of political parties and governments, number one. Mm-hmm. And number two, with that independence, they have set interest rates based on an inflation target. And the inflation target, as you said, is 2%. Now, my own sense, I feel that a little bit of inflation is always good because in general, I'm a debtor, right? So basically there is a conflict at the heart of economics between creditors and debtors. And a 2% inflation rate is like a little bit of debt forgiveness all the time because it basically knocks 2% off your debt burden every single year because the rate of inflation reduces the rate of debt.
But also off your savings. At the same time.
This is the thing. So I would be a certain person who does not eulogize savings. So there's a whole part of economics that is basically got a savings fetish, right? Yeah. There is a weakness, I would say a bias in economics, which is to elevate the virtue of saving over the virtue of spending. And this, I believe, is because economics stems from, dare I say, Scottish Presbyterianism. If you look at the Scottish Enlightenment, this is where the Adam Smith idea is that economics comes from. And a default position of those Calvinist types in the 18th century was a notion of sobriety, a notion of savings, a notion of modesty, etc. So the reckless spender was regarded as somebody who was reckless and spending other people's money.
Yeah.
However, if you are at your core, and I probably am a Keynesian economist, right? You need to understand that if an economy is not spending, John, and is saving all the time, right? Something bizarre happens to demand. So basically, the essential nature of economics is the following. Your spending is my income.
Yeah.
And my income is my spending, and my spending is your income. So it goes around and around and around. And the font of all savings is income. So savings comes from income. Income doesn't come from savings.
Yes.
This is the basic building blocks of economics. So if we jaundice economic policy to elevate saving, we are by definition undermining income and by definition undermining the font of future savings, which is income.
Right.
So I would say better to have that little bit more recklessness, that little bit more exuberance, John, that little bit more enthusiasm for the spend, because that's what generates demand. That's be the Keynesian in me. However, the 2% inflation is plucked, as they said in the Anglo-Irish thing, out of his arse. Do you remember the Anglo-Irish? Where did you get the 5 billion figure? I plucked it out of my arse.
David Drum.
This is the intellectual version of David Drum, right? So ultimately, the 2% comes from nowhere. It just sounds good.
Right.
Because it sounds better than 5.
I was expecting you to
5%.
whip out a big chart and...
No. However, that being said, there is an interesting article in the Financial Times this weekend by a friend of the show, Adam Posen, a man who's been on the show, and he's talking about why anchoring inflation expectations in 2% and building that over a 10 or 20 year period with an independent central bank creates what he would call credibility. And eventually what happens is inflation goes back to that level. Why? Because we know that's where the central bank wants it to go.
Okay.
And if you look at all central banks right now, there is an extraordinary convergence in global monetary policy, which is that ECB just cut rates, the Canadians just cut rates, the British will probably cut rates, and of course the big one is the United States, right?
Yeah.
So that in and of itself is quite interesting. That's the first thing we want to talk about, is the global convergence, right? But the second thing we want to talk about is actually what's happening in the minutiae of the market, right? And for that, we need to get somebody who really knows and plays on a daily basis.
Yes.
So we're going to go now to the head of capital markets of Cantor Fitzgerald, Dave Tilson, who's operating in the markets and has been doing it for many, many years on a daily basis. Let's go and talk to Dave, see what's going on. Now, over the last couple of days, because I am interviewing David Baddiel at Dalkey on Friday night, I've been kind of going back to Baddiel's career as a football pundit in the early 1990s. You might remember Fantasy Football League with David Baddiel and Frank Skinner. I've also been getting into the Lightning Seeds because of the footballs coming home. So I'm really locating myself in the early to mid 1990s. And of course, my football career then was more or less watching Baddiel and Skinner and playing a little bit of ball in a place called Battersea Park in London, where I lived. But our next guest actually played the real thing. Middle of the park for Bows from 89 to 94. Not only has he got an FAI Cup winners medal, he actually scored the winning goal. He then played for Shells 94 to 97 and has another Cup winners medal. Dave Tilson's on the line. Dave, how are you?
Morning, Dave. How are you?
And the reason I tell you that story, listeners, is that there is hope for all of us. Because now Dave Tilson is playing in the middle of the park with me. So if your football career at your early age seems floundering and seems located on the couch and nothing more, never fear. in your 50s, it'll all come good. Dave, how does it feel to play with such a general in the middle of the park?
Is that what you're calling me these days, Dave, the general, yes? We have a slightly different name for you, but anyway, that's maybe not for the podcast.
Anyway, Dave, listen, great to see you. Great to see you. You're now at Cantor Fitzgerald. Cantor Fitzgerald are also sponsoring the Baddiel show in Dalkey. It's great to have you on board at Dalkey. Dave, let's talk about global financial markets, because we've just had a whole flurry of elections, right? And in the old days, there was always this connection between politics and markets and when it went up and down. What is going on in markets? What are the big trends? Let's say in the US first, then we may go to Europe, then we may go to Asia. And explain to the listeners, because lots and lots of listeners, particularly the younger ones, have been locked out of the housing market. They're saving their money. They're thinking, where can I make a few quid? Where can I actually have a punt? Where can I learn how to invest for the long term, particularly the younger ones? So explain to me, where are you seeing trends going in the world? Let's start with the States.
All right. Well, we probably start with the background, Dave. And I think, the last few years, it's all about inflation and what central banks have done to try and quell the obvious kind of rise in prices that we've seen. So it was somewhat ironic after the great financial crisis and after the euro crisis, central banks were worried about deflation. Inflation wasn't high enough. Rates were set at zero in the US and the UK. Rates were negative in the Eurozone. That all changed after COVID, and we saw this massive inflationary spike. Central banks originally kind of slow enough to react, but then they got themselves in gear and they started hiking rates. So you saw this massive rise in interest rates all across the world. US and UK interest rates are now at 5%, just above. Eurozone was at 4% up until this week. So you saw a massive rise in interest rates. Now we're at the top, or it feels like the top, and it feels like rates are going to start to actually come down a little bit. So that's the kind of economic background there. As inflation went up towards 10, 11%, rate hikes, topped out, started coming down, central banks on hold. Inflation rates now are, still a little bit above target at around, 2.5%, 3%, but a lot closer to target, and target is generally seen as 2%. So central banks have a little bit of leeway to actually cut interest rates. We saw the ECB cut for the first time in 5 years, a small cut from 4 to 3.75. Bank of England and the Fed kind of expected to do the same over the second half of this year. So that's the background. Inflation has come lower. Central banks possibly about to cut rates because of that. So that's a reasonably positive kind of background in a broad sense, both for equities and for bonds looking forward.
And so let's look at the United States, right? Because I just saw the latest employment figures. So every first Friday of the month, I remember again working in the business years and years ago, and it was a big deal. It's a thing called the non-farm payrolls, which shows you how many jobs the American economy is creating. Financial markets look at this and they say, well, look, if the jobs are more than we expect, then the chances of the Federal Reserve cutting interest rates are on the back burner. If they're less than we expect, the chances of the Fed's cutting interest rates are raising, depending on which way you're looking at it. I saw the other day there was a very strong number again, another strong number in US employment. What does that do? Just explain to me and the listeners, what does it actually do to the headspace of the central bankers in a way? And then what does it do to the investing community?
Sure. I mean, if we went back to the start of the year, the market was worried that, not worried, the market was forecasting that growth was going to slow down materially. Okay, so central banks hammered the economies with interest rates. That was the only way inflation was going to come down. And actually what's happened is growth has been a lot stronger than the market and indeed central banks have expected. So at the start of the year, the market was looking for maybe 6 or 7 interest rate cuts from the US this year as the economy slowed down and potentially went into recession. That hasn't happened. And the term the markets have been using has been immaculate disinflation. So inflation has come down without, so it's come down without actually destroying the economy in the process. And we saw that again with the latest US employment report. So the jobs growth there was over 200,000 again. The unemployment rate in the US is at 4%. So what does that mean? For central bankers, it means the economy is still growing quite strongly. Inflation is still above target. So actually, there's really no need to cut interest rates immediately. So what happened yesterday? I mean, equities sometimes, I think equities are great at saying the glass is always half full. But yesterday, it sometimes gets to a stage where good news is bad news for equities, in a sense that, the economy is growing strong. Oh, the US Fed are not going to cut interest rates, and equities sell off on that basis. And that's what we saw on the back of the latest employment report in the US.
So, David, if we stand back, right? So, equities, we're talking about stocks. Okay, well, if we go very basic, right? So, in an ideal world, when the economy is growing, there should be more profits generated in these companies. Those profits should generate a stronger bottom line, and they should increase the value of those shares to shareholders. But when the economy is growing, interest rates are likely to increase. And this is likely to increase the price of debt on the balance sheet of the company. And this is likely to undermine the share price. Is it a sort of a balance? If we get really basic, is it sort of a balance between these two, when you're looking at stocks?
It is really, but the first one dominates.
Okay.
So at the end of the day, at the end of the day, if economies are growing and as you say, output is growing, well, then it's likely that, equities will increase in value. And you get sometimes at these turning points, as we kind of mentioned a little bit earlier on, where it can become a little bit more muddled. But generally, economies grow over time. And if you look at a chart of the S&P over time, it goes from the bottom left to the top right, if you're looking at a chart of it. And that's the correlation.
So basically growth is the key thing, right? So in the United States, we've had this bizarre, I love this immaculate disinflation. This is a term I would love John to have come up with myself. In actual fact, I might just purloin it on the slide. But let's look at Europe, because again, you have this kind of counterbalance all the time. And then we want to look at Asia, because I would like to see what is going on in Asia in terms of the growth, because the growth of Asia has been phenomenal. But what's going on in Europe right now? And maybe to a degree in Ireland, but let's go big Europe before we talk about Ireland.
Yeah, so Europe, the ECB cut rates during the week. So they've become, I suppose Canada cut a day beforehand. So they were the first G7 central bank to do so. So Europe has actually got out of the blocks a little bit quicker than the US this time, which is unusual. And that probably says two things. One is that inflation is probably closer to the ECB's target than maybe it is in the US, or they've more confidence around that inflation backdrop. But two, that growth is slower, particularly in Germany. So you've seen the German economy post-COVID has struggled. So while the ECB increased their GDP outlook, their growth outlook for Europe, even while they were cutting interest rates, still, if you compare it to the US, it's a much more benign kind of growth backdrop. So that's the big, there are two differences. One, inflation is lower, but two, the bigger thing is that growth is a lot slower in the Eurozone than it is in the US.
David, just want to ask you, just anecdotally, we were chatting through the week, you said you were in Germany. I always think sometimes it's kind of anecdotes are quite of interest. So when I'm reading the pages of the financial press and the political press, there's this sense that Germany is going through this period of kind of self-reflection. The economy is slowing. We've had a few German economists on over the last year. They're saying there's a sort of amount of neurosis going on in Germany. We know at the weekend there's been a big surge in the right wing. You were doing business in Germany this week. Is there a sense when you talk to German clients, German money managers, German asset managers, that they are worried about the economy there and they're worried about the society in general?
They are worried about, I suppose, structural issues in the German economy. They're worried that they're not exporting the type of stuff that people need anymore. They're worried that, their expertise in say, car production, they outsourced a lot of car production to China. And effectively, China robbed all their IP. So they're worried about that. So they're worried about a lot of things. They're also worried about the war being very, very close to their to their borders. So lots of worries. Having said that, it was a lovely day in Munich. It was 25 degrees. People were looking forward to the opening ceremony of the Euros. Germany plays Scotland there next week. So look, it wasn't all doom and gloom. And the trains ran on time, and it was all it still worked very well. German efficiency is not dead.
Well, the last time I was in Germany, I was in Gelsenkirchen to watch that great poacher of goals, John O'Shea, who was now manager of Ireland, poke in a most brutal goal to get a one. Do you remember the 1-1 against Germany in the qualifiers about 10 years ago? And Dave, can we just turn now a little bit to Asia, right? And I know, again, we're doing very, very Picasso-esque broad strokes here, but let's turn to Asia. You just mentioned the Chinese robbing the IP. The Americans have slapped 100% tariffs on Chinese electric cars. That sort of side of things is not going well. Where do you think, or where do you sense money in Asia in general is going? What are the big themes in Asia that we should be aware of?
First big theme in Asia is buy India, sell China.
Oh, interesting.
Yeah, you look at the performance of the Indian stock market, and okay, we had an election there last week with Modi getting back into power with a slightly kind of smaller majority. But generally, India has been doing very, very well, and China post-COVID hasn't. So whether that's a knock-on of the massive effort during COVID to ensure that things sort of completely locking down the economy and they just haven't been able to get out of that, whether it's because you've got this massive amount of property debt and the property market's a real problem over there. So China has performed very poorly and India has performed extremely well.
That's a fascinating theme as well. Sorry if I just break it. That is a fascinating theme because again, that's, there's been a 30-year China growth story in effect, kind of baked into markets and perceptions of politics and economics and geostrategy. And fascinatingly now, what you're saying is that the sense is that India is the place where the dynamism is.
Yeah, it is, absolutely. And actually, the other interesting piece traveling across the globe is Mexico is doing extremely well on the back of the China-US kind of difficulties and trade tariffs. So seeing a lot of, and obviously COVID as well, where supply chains became an issue. So you're seeing a lot of US firms setting up or effectively manufacturing in Mexico and bringing it across the border. So Mexico has been a huge beneficiary also of the breakdown in the kind of US-China kind of détente over the last number of years.
That's fascinating. I hadn't thought about it. But again, that's the sort of thing, if you are going to go into the investment game, you just have to be aware of all these various dynamics and the complexity of the system. And, something happens over here and suddenly you've got an event that you never really predicted over there. And it's just trying to keep on top of all this stuff. It's a bit like trying to actually just keep on top of a puzzle that continues to move. That's the thing about financial markets all the time. The interesting thing about Mexico is as the economy's taken off, they're voting left, not right, which is kind of funny in the last couple of weeks. So let's come back a little bit. I know a lot of Irish people, a lot of people listening to the show are over in the UK. The UK, the election, sterling, UK bonds. What's your sense is going on over there?
Yeah, I mean, I suppose the market is kind of looking at the UK election in early July. It's a little bit of a shrug, to be honest with you. I mean, Labour are so far ahead. They're on 44%. They have been for quite some time. The Conservatives are down in the low 20s. You have this sideshow going on with Farage, so the Reform Party, the ex-Brexit Party have gained a little bit of ground, et cetera, et cetera. But broadly, the markets are kind of going, we know how this is going to play out. Labour are going to win. It'll be Tony Blair, 1997, not Neil Kinnock, whatever, in the 80s.
Yeah.
So, look, it's done. And the other thing about the UK is, given what happened with Liz Truss and, her attempt to, really kind of, take the cannon out and how that ended so badly and that the lettuce survived longer than she did, the ability... It is awful, but look, the ability, I mean, for the next 20 years, it's hard to see anyone trying that again, okay? So the markets are kind of looked at it kind of going, look, there's limited enough space for Labour to really do an awful lot. And so the market's kind of shrugging really and thinking, look, we know how this is going to pan out and it's going to be okay.
So Dave, just pulling back, right? Because I know that you have been a bond specialist for most of your career. Explain to me and the listeners what is going on with bond markets, because there's a lot of people, again, listening, will have a few quid in their deposit account. They're getting, even though interest rates have gone up to 5, most people are getting, very, very little return on their deposits. So explain to me how bonds might offer an alternative, why other things might offer an alternative to actually get a decent income without taking too much risk.
So look, I mean, bonds, pre-COVID were a very boring place to be, and a lot of them were actually yielding kind of negatively. Central bank, the European Central Bank had rates at negative. So in other words, if you bought a bond then, you were actually going to get back less money when it matured in 2 years' time or 3 years' time, bizarrely, than you put in. Since then, as I mentioned, interest rates have gone up. So, bond yields are, directly or indirectly tied to where central banks actually park interest rates. Okay, so roughly now, Eurozone will have a 3 handle on it. The US will have a 5 handle on it. So bonds are back as an investable asset class again. So you can now go out there and buy, a bond issued by a European government. It could be a 3-month bond, or a 1-year bond, or a 2-year, or you could, go mad and go out to 30 years, but I wouldn't necessarily recommend that. But you can go out and buy, French government 3-month T-bill that would give you, 3.25%. Up until recently, that was higher. Up until they cut rates, it was, nearer kind of, 350, 360. So guaranteed by the French government. And the good thing about them is they're called liquid. And you'll know what liquidity is, which means you can actually buy and sell them. So it doesn't mean, a lot of people think you buy a bond, you have to hold it for the full length of that bond. You don't necessarily. You can actually go out and get your money back in 2 days' time if you actually need the cash.
So you'd be kind of like, if you do a little bit of research, you'd be kind of bonkers to be keeping your money on deposit at whatever you're getting, 0.5% in the local bank, as opposed to you're getting 6 times that, courtesy of Mr. Macron, who's not going to default. Absolutely, yeah. And now the Irish government don't issue these type of T-bills because they don't need the money, actually, as we kind of know. That's what happens when you have a big surplus. You don't need the cash. Exactly, yeah. But Germany, Belgium, the EU issue T-bills or whatever. So they're a very liquid instrument, as mentioned. And as you say, they offer a multiple of what you're getting in the Irish banks on deposit. No, I mean, again, that's fascinating because as I come back to the point that there's so many people who are locked out of that traditional Irish asset, which is, and we've talked about this on the podcast, whether it's right or wrong and whether it's good or bad for society, but it is what it is, which is that Irish people invested their money in getting a flat, getting an apartment, hopefully putting a deposit in a house. That is out of reach for many, many people because it's the numbers are just too astronomical. So in actual fact, to try and make your money go a little bit further, you should probably try and educate yourself, if you're not already doing so, in this area of financial markets. Lots of pitfalls, lots of things can go wrong, but if you do a bit of Eckers, lots of things can go right. Dave, if I can actually pull back a little bit more, just final sort of question, which is when I started this business, and many, many people listening would have been aware of the dominance of banks in lending to the economy, right? So basically what you had, you deposit your money in the banks lend to somebody who wants to actually borrow that money, and that's basically how money was transferred around the system, and particularly in housing market and property and all that. We understand that. The last 10, maybe even 12 years have seen the emergence of, what you call private money, private equity. People complain a lot about big private funds in the Irish apartment market or whatever. Can you explain to me what's happened so much so that, in the United States in particular, private money seems to be investing in areas where public or bank money used to be the way to get finance? And what does that do to the financial markets in general? Yeah, look, I mean, you're right. Private equity has been around for quite a long time. You look at Wall Street, Gordon Gekko, that's kind of what he did, right? Yeah. He was a kind of a private guy, and he went in with his equity and took over companies and did what he did, right? Private credit is a relatively more recent one, but one that's shown massive growth, particularly in the US, but also in Europe. And it's this idea, as you said, that, rather than going to your bank for a loan, and Europe in general, not just Ireland, but Europe is massively reliant on its banking sector to provide liquidity and capital. And as we saw during the crisis, if something goes wrong, the whole deck of cards literally kind of falls down. In the US, in contrast, they are much more used to using kind of banks for some bit, but the actual capital markets, right, which is a mixture of public, which are equities and stocks that we spoke about, and also private. So you've seen this big move, even in the States, where you had banks and kind of, public, as in shares, into private as well. Okay, so the private credit market is now providing both liquidity and capital to firms. So it's like, instead of, going to the public market and issuing a bond, you will go and talk to what are called these private credit firms. Some of them people might be familiar with, say, family offices. Yeah. Okay. And some of them are in Ireland, right? So effectively, now they can invest in a mixture of, public shares and bonds and whatever, but they also invest in private markets. So they will look at things where they will do a private deal. It's not equity, it's debt. It's a kind of a loan with another company, and it's private. That's the whole point. So the deal is between those two corporate entities. And we're seeing a lot more of that happening, mainly in the US, but also in Europe.
I hope that's explained it well enough. It's quite a complex kind of area.
It's explained. It's just this. The reason I ask you is that a lot of people might have noticed last week that the massive big fab in Leixlip, owned by Intel, which is a publicly traded company, 49% of it was sold last week to a private company. Now, it doesn't really mean a huge difference for the actual operation of the fabs and the chips that are made and all that sort of stuff, but it just shows you the way capital is moving around. And again, this is something you got to be aware of if you're getting into this game, that there's, as I said about the something happens in China, then Mexico's kicked off. You've got to be aware of all these huge trends. Now, Dave, I know you're heading to London now, so I'm going to let you go. But listen, that was wonderful stuff. Would you come on again?
Very kind. I'd love to, Dave. Been great.
So the big message I'm getting from Dave Tilson there is sell China and buy India.
Yeah, it's an interesting one, isn't it?
But the other thing that I was thinking about as he was talking there is, and I know this is probably really obvious to many people, but how money flows. Like, there are no borders with money.
Yeah.
And we're all, particularly now in the kind of political sphere, it's all about, nationalism and protectionism and
all the
trade
isms,
wars. Yeah, all that kind of stuff. But capital still flows freely. It's kind of apolitical.
This is one of the fascinating issues. Just before I answer that question, I would like to say that I noticed there that Dave Tilson displays the same patience in explaining economics as he does on the pitch, waiting for a return through ball from me. Right. So you can imagine, right? You can imagine like a guy who's played at that level, right? Because we're all getting old and whatever.
Yeah.
But like, he's thinking 5 moves ahead. Right? And he's playing with us.
He must find it really frustrating.
Sometimes I look at him and I just see him, he's got his head in his hands and he's kind of looking out of the corner of his eye, and he has figured out where the ball is going.
Yeah.
And the rest of us are like headless chickens running around after it. So, Dave, listen, for your patience in explaining economics, finance, markets, and in waiting for the 1-2 from me when he says 1-2, and I'm like, what? 1, 2, 3? Anyway, let us actually go and talk about what your point, and I think you got a fascinating insight there, John, which is the following. And maybe this is what the book I've just written about money is all about.
Oh, right.
Which is that money is not sovereign. And that is a thing we need to get our heads around. So money, global money, is more powerful than any country, than any army, than any ideology. It runs the global economy. And the key thing is that money is permeable. And by that I mean borders are permeable. Money flows always like water. Yeah. Water flows on what you would call the path of least resistance.
Yeah.
And money is exactly the same. So we have this extraordinarily bizarre, invented concept called money, which is a figment of our imagination. It doesn't exist in reality. And yet it is more powerful than any other force in the world. And as you said, we spend an enormous amount of things saying, okay, money is sovereign. So the euro is printed by the ECB and that's in our back pockets and that's what money is. Or if you're in Britain, the pound sterling is printed by the Bank of England, that's in our back pockets. Or of course, you're Americans, the dollar, right?
Yeah.
That's actually not what happens, right? That is a small, small fraction of the money in the world, which is the money that's stamped sovereign. But what actually happens is money is global. And 21st century money is even more global than ever before because we have no capital controls. So in the past, we had controls, a certain amount of limitations. You could only export. It's amazing when you think, even when we were young, John, there were capital controls in Ireland. So you couldn't take X amount of punts out of the country, nor could you import X amount of dollars. That's all gone now, right? So a crucial aspect, and this is what Dave is talking about there, is something happens in India or China, and you get a reaction in Mexico. Now, what is actually tying them all together is global supply chains. But what's tying all the money together is what you call contagion, which is that every asset manager, every investor has a little bit of this and a little bit of that. And a little bit.
Yeah.
So portfolios are always being reassessed, realigned, refigured out in a way. And the key thing to understand, and this is a big part of the book, is that money does not want a home. Money wants to flow and wants to be international. And we, as you said, spend all our time talking about nationalism and thisism and thatism and the power of the state and all that. In effect, central banks do not control the money supply. Commercial banks control the money supply, and central banks only set up the guardrails.
Okay.
So they kind of want to reassure us that they're in control, because ultimately humans quite like somebody to be in control of something called the money.
Yeah.
But in reality, the way in which money is created worldwide means that central banks have at best what I would call a nudging role, a slightly massaging role on the quantity of money. And in actual fact, the quantity of money is a function of the private banking system, and the private banking system allows money and encourages money to go wherever it wants. So nobody's in control. But the interesting thing, John, nobody's in control, and yet the system works. And this is the beauty, and we're going to end here, of complex systems, right?
Right.
That the global economy is a complex, constantly adapting organic system, a little bit like nature.
Yeah.
So there's nobody really in control of nature.
Yeah. So it's living in our heads.
So basically, there's a great expression, which is a design without a designer. Now, I believe that the global monetary economy is a design without a designer. So there is no marionette puppeteer at the top orchestrating the entire thing, that actually feeds on itself, with itself, nourishes itself, and creates all sorts of new opportunities all the time. And that's the essence of understanding complex systems. And money is the ultimate vector of a complex system. There you go.
Jesus.
Talk to you next week.